PNC Bank was chastised, ridiculed from Wall Street for not making subprime mortgages. Anybody is making them, and they're flying off your balance sheet. Securitize them. You guys are not with it. You're kind of an old and stodgy bank. You don't really get it. In 2008, we looked at National City Bank, circa April of 2008. Flew to Washington, met with different people at the Office of the Comptroller of the Currency, and we said we won't buy them unless you help us. They said, there's the door, don't let it hit you in the behind on the way out. And we forgot about it and said, well, gee, these guys have got some problems. 2008 keeps going, it's now October. Now you've had Bear Stearns, Lehman Brothers, Merrill Lynch, it goes on and on, right? The federal government calls us. They say, hey, we're the same guys, remember, unless you help us, we're not really interested. Well, we're doing this thing. It's called TARP. And we would like you to think about buying them with TARP funds. And most of you think TARP is a four-letter word, which it is, and it's nasty, and it has all these bad connotations, if you will. It was meant to stabilize strong banks. So if I tell you that National City was not going to get TARP and that they were going to fail, it would have cost everybody in this room that writes a check every April 15th money. So 2 days later, after we announced our acquisition, which, by the way, for those of you in the room, who in here has lived most of their lives in the state of Michigan, just out of curiosity? Does anybody in the room remember a bank called First of America, based in Kalamazoo? Well, just to frame it for you, we paid less for National City in 2008 than they paid for First of America in 1998. So talk about destroying shareholder value and shareholder equity, there you go. So 2 days later, I got an all-expenses-paid trip to Cleveland and got to come back when we got the regulatory agreements lifted. The reason why a number of us went, including our vice chairman, and we lived there all together, it was like a fraternity or a sorority, I don't know, because there were males and females, was because we thought mistakenly that we could collapse the charter of National City Bank, absorb them in, and go on our merry way. And we realized we could not, because if we collapsed their charter, we would go under regulatory agreement. So we fired the board and some other folks at the top that were responsible for making these decisions. By the way, the 4,500 people in the state of Michigan had nothing to do with these decisions. And yours truly went on the board of directors and became its chief credit officer. But keep in mind, if you don't know this about Cleveland, but right across the street from National City is the headquarters for this district of the Federal Reserve. So each week I met with the Federal Reserve and the Office of the Comptroller of the Currency, taking questions from people that were somewhat, maybe you could argue, asleep at the switch when this all transpired, right? Then they were chastising me for being a day late on something. And so it was really strange times. Just to frame it for you, when I left, our stock price was 50, right before the acquisition. I want to say it got as low as in the high 18s. So those of us that were in Cleveland weren't liked in Cleveland, and we weren't liked in Pittsburgh. People in Cleveland, think about it, you got a Detroit Lions sweatshirt on, but think about it, the Steelers are buying the Browns. I mean, it was like marriage made in you-know-where, right? And there was a lot of emotion involved. Turns out our chairman of the board at the time was from Cleveland, grew up in Cleveland. His father passed away when he was 11 years old, and he worked in the family restaurant. When people found that out, they actually started liking us. We used philanthropy to get our message across at a program called Grow Up Great. And before you knew it, there were people who were saying in Cleveland, hey, what, these guys aren't so bad. In Pittsburgh, they didn't like us because like as if I'm the one that decided on the merger, but they were concerned because of the stock price. By the way, if you want to just reference it, our stock price today is 84. But during those times, going back to my boat race, I'm sitting there thinking, okay, how do I sign these financial statements? I promised my wife one thing. I promised her I'll do anything for the firm, but I won't go to jail. Common thing, right? And what I ended up doing was the portfolio gets marked to market So before we closed, we marked all the loans to market and then had a certain frequency. Every quarter we'd mark them to market. And I was very well versed, and I'm, I guess, somewhat of an expert at commercial credit, but I was a little bit rusty in consumer. And so after we got done with the portfolio on the consumer side, it would go to Virginia on its way to Pittsburgh, and some secondary firm would look at our marks, how much we were valuing these consumer loans. So if you're in my shoes, I'm thinking to myself, when it left here, it was okay. It's like taking the car out, right? I mean, there wasn't any dent in their honest dad, when I left, but that's never happened to any of you, I'm sure. But could not opine to what those marks were when they left my office, went to Virginia, and then went to Pittsburgh, which is our headquarters. So I basically decided, there's your Kodak moment in your life, that I would say that I was fine with the marks in the commercial portfolio and the consumer once they left Cleveland, but was not going to opine when they got back to Pittsburgh. My phone rang one night, and it was our controller and our CFO. It's a long conversation, and they said, "You're not changing your mind, are you?" And I said, "I can't, because I don't know what they're doing in Virginia." And they said, "Well, you should do what you need to do." And every quarter thereafter, I signed the same way. I share that story only because you have to have convictions. They didn't make me sign it. They appreciated my convictions. But also the message in that story is that a lot of firms get intoxicated by Wall Street, and that it gets to be like a lust for quarterly earnings. We never went there. We sold our mortgage company in 2002 to Washington Mutual, those guys, because we didn't think we had scale. We probably would have liked to sell the mortgage company when we bought National City, but if you think back to 2009, probably not a good thing to get out of the mortgage business when you're using some government funds to help acquire something. So there's only two institutions in the country that use TARP to buy somebody. Wells Fargo bought Wachovia, and we bought National City. Well, that money was paid back, of course, and then plus a return, and ended up being a pretty good deal for, I think, the taxpayers when you think about it. But the message of that is that you need to really stay the course on a strategy, even when you get bombarded from the outside. I think you'll find that PNC Bank is pretty unique in a long-term view. It's not easy, it takes courage, but if you think of our philanthropy, it's the same way. Our philanthropy is a long-term investment. It's early childhood education. When do you get returns on that? It takes years. But our philanthropy really is a testament to this long-range view of something. Our employees get 40 hours paid time off a year if they donate that time to educational matters. That's a week. There's nobody, I think, in this region that has anything like that. But it's a long-term investment, we view. But when you think about the financial crisis, the things that National City did that got them into trouble had nothing, again, to do with the people in the state of Michigan, but there were things that we did not do. Subprime lending, brokered home equity, and they had an uncanny knack of buying savings banks in Florida at the world's worst time. So we ended up with lots of condos. But when you think about that, it's easy to get intoxicated. In fact, at an investor conference, the former chairman of the board of National City pretty much poked his finger at our chairman for being not with it. Think about that hotel room meeting before the merger's announced when we're buying them. You think for a minute our chairman didn't remember that, especially being a Cleveland guy. And that must have made him feel pretty good to stay in the course, all the pain that goes around and associated with that. So those are the things that got, I think there's a misconception that everybody was doing all these things, and it's actually it's not true. When you think about the responsibilities in the financial crisis, and I was saying this earlier, everybody talks about bad behavior of brokers, of banks, of real estate agents, title companies. This is unpopular, but nobody ever talks about the responsibility of the consumer. I can tell you, when my daughter came home and said that her friend Julie had a $310,000 mortgage at the age of like 25, and I know Julie, and she probably was making $28,000, $30,000 a year, I thought, the smartest guy in the world, but I think there's a problem here. When the guy that's parking my car in Naples at the Ritz-Carlton is speculating in real estate and telling me I'm crazy because I'm not jumping in, maybe there's a problem. I'm just saying. But I think a lot of times it's not fashionable, it's not to talk about responsibility. And I think each one of those groups, brokers, title, mortgage bankers, you name it, had a responsibility, but also so did the consumer, I think. I think that gets lost on a lot of people. But it was pretty, quite frankly, nerve-wracking to be us, but it was pretty cool to be us. So fast forward, so there I am, just like you would be, January 2nd, 2009, it's a Friday, it's the first day of my official job as Chief Credit Officer of National City Bank. The line outside my door looked like a delicatessen or something, you know, take a number on the wall. And it seemed like people felt obligated to tell me stuff. I mean, stuff that had nothing to do with credit, too. It was like, gee, I better tell you, you know, fill in the blank, especially the audit people. They were really nervous. My first official act, in case you're wondering, was to tell people that we're lending to subprime lenders, some of which were investment grade, that they had to get out of that business by a certain date. One of my nasty things to do was to decide which businesses we would no longer participate in. And, you know, you can argue with me if you think I'm right or not, but it was just an opinion that we got out of equine lending. If you don't know what equine lending is, it's lending on horses. So like he owns the future horse that's going to be born by these two horses in 2017 and you lend him money. I'm not being too far off on it, but I'm not trying to be facetious, but there's actually, we've done that once before and didn't have a good outcome. Got out of that, casino lending, not for us, but also lending to payday lenders. Why would you lend to somebody that's lending on terms that you wouldn't lend on? Seemed kind of obvious to us. It was against our policy. We think it's predatory lending. And so we got into kind of a heated debate in my office to the point where I put the phone on the speaker and said, let's call the chairman of the board, and who was just adamant that we don't do those things. But I think it represents kind of a cultural difference, if you will. Back in the 90s, the culture of National Bank of Detroit, National City Bank, and Pittsburgh National were pretty much the same. And then you kind of see that different people go different ways based on what the strategy is, and sometimes I think the strategy is the flavor of the month, and I think you need a long-run view. I should back up and frame it for you, because we're not the same size as some folks. So let me just frame our size for you. Our market cap today, unless I haven't checked today, is probably about 44 billion, assets of 318 billion, 7,500 ATMs thereabouts, about 2,800 branches. So that puts us 6th or 7th, no matter how you're. So we're not one of those top four, not Citibank, Chase, B of A, Wells Fargo, the $1 trillion club. We're in that group with U.S. Bank and one that you know and love because you see the commercials a gazillion times a day, Capital One. We're about the same size. We're in that next group. So we're not the too big to fail guys, but we're definitely significant, and we are a Basel III bank, which comes with a bunch of different rules and so forth. Last year, just under $4 billion after tax, probably about the same this year. So what makes us different, maybe, is that we have large bank products, local delivery. So we deliver everything local. The building at Big Beaver and I-75, we can commit to the legal lending limit of the firm. Just that's a scary thought. But we also, our treasury management people there, our derivatives people, our foreign exchange people, maybe a little bit more expensive, but we believe that we have to localize our delivery channel. We also localize our giving. So I chair our foundation. There's not somebody in Pittsburgh with a spreadsheet trying to decide whether we should make a $5,000 grant to some group, say in Madison Heights, Michigan. We chair it locally, which is consistent with our delivery model when you think about it. Makes us a little unique, but and more expensive, but we think it works for us. So that frames PNC for a little bit for you. But I think the lessons learned are forgotten quickly. Banks are notorious for short memories, right? And so you're seeing it again. You know, I'm starting to see, in fact, there was an advertisement in New York about no-doc mortgages, which stunned me because it's New York. with probably the roughest attorney general in the state, in the country. So that kind of stunned me. I'm seeing loans which call a covenant light, where there's just a couple of covenants that you could drive a truck through. So you're starting to see it. It's a great time to be a borrower. But when you think about it, it's simple economics, right? There's too many banks. If you talk about an industry that has way over capacity, it's the banking system. We have fewer banks than we used to. I'm not advocating Canada with 6 or 8 banks. But we do have a lot of banks, and so sometimes you'll see that people lose their brain. And we basically refuse to do that. And I think that's why our share price has done so well and continues to do well. Speaking of uniqueness, for those of you who are in finance classes and for those of you that are in investment classes, we still own 21% of BlackRock. BlackRock is the world's largest fixed income manager, world's largest. Now, I don't have a calculator, but I will tell you that it's the most successful bank acquisition in the history of banking. Let me walk you through it. In 1994, we paid $240 million for all of BlackRock. Today, the 21% is worth about $9.6 billion. I don't know. I'm just saying, seems like a pretty good acquisition to me. But it also gives us some world-class capabilities when we go out on the investment side and our short, whether it's on our small cap fund or our international, especially on our international funds. So it's really something we have that really nobody really has, and quite frankly makes us pretty unique. Some of the topics that came up, City of Detroit, very involved in that. A lot of people want to hear about it. We're, I guess, in the 8th inning. We're getting close to the 9th inning. I really think that what you've seen here is historic. It's the largest municipal bankruptcy in the history of the country. We're interested in it for the obvious reason of economic viability of this region. But we also have a portfolio of $8.7 billion in muni bonds. Not City of Detroit. We have no City of Detroit bonds. But with that said, this is becoming precedent, right? So whatever is happening in Detroit is going to start rewriting the legal precedent language for this country. So if people think, well, gee, they're based in Troy, what do they care about what happens in Detroit? There's all kinds of reasons. It's both Southeast Michigan, state of Michigan, and then it's really national. And so it's going to be interesting to see what happens there, but I'm hopeful that that will be behind us. It's really going to be unique to be mayor of Detroit, right? You'll have one of the best looking balance sheets in the country. The key to success in my mind is that we don't go back and make the same mistakes we've made in the past. When you think about Detroit, 139 square miles, right? You can get Manhattan, Boston, San Francisco in it with room to spare. I think we all like to talk about Midtown and downtown. There's 29 projects downtown, not counting the Red Wing Arena. This thing's just happening there, right? But what about at, say, 6 Mile and Evergreen in Brighton? I think I just nailed it. I think it's at 6 or 7. So really the issue, I think, for Detroit is to try to find a way to also get that prosperity that's starting to happen in Midtown and downtown into the neighborhoods. And what do you do with all that land? Right? If you look at future city Detroit, it's on my coffee table at work. It's just this huge manual. There's lots of ideas, urban farming and everything, but I think that's going to be the issue because otherwise it's going to continue to put an incredible strain on the resources, trash, fire, police, EMS, etc. So it's going to be interesting, but I think it's exciting. Kind of a new frontier, if you will. We were involved in the financing of Cobo Hall expansion. I'd have people come up to me and go, "You lost your brain? Why are you lending Detroit money?" And I would say that the Cobo Hall expansion is a metaphor for regionalism. It's not a loan to the city of Detroit. It's really a loan that's backed by counties of Wayne, Oakland, and Macomb County. The benefit, I think, finally, we figured out, you know what? So Detroit goes, we probably go. And we need to put our collective energy around that. And so I think that's a good example of something that went really well. It was us, it was Wells Fargo, it was B of A. But we did that deal, but you would not believe some of the people that didn't know, and there they went right back to their thinking of, know that, this is Detroit versus the suburbs versus the state, and hopefully we've knocked that out of a few people. I would offer to you that the people in this room, the younger people, aren't encumbered by all the baggage that some of the people, maybe my age, had about Detroit. They have a much better vision and can-do spirit, and actually I think also are much more philanthropic than my generation. And I think that's why I think there's going to be some economic vitality to Detroit for years to come, at least I'm hopeful anyway. What would it be without talking about risk for a second? There's 4 buckets of risk for banks, the most obvious being credit. And obviously you have credit risk, market risk, liquidity risk, and operational. If you think of the financial crisis, it wasn't a credit risk, it was a liquidity risk. It was like 1929 and run on the banks. But the biggest risk out there probably, and the hardest to measure, and you heard in my bio, I went to Wharton, I got an advanced degree in risk management. I was finishing that degree in 2008. You should have seen the people at Wharton. If you don't know anything about Wharton, they're quantitative analysis all the way. Anything qualitative is hogwash. It's all, you can measure everything. Let me tell you, you should have seen the anxiety on some of these professors' faces during the financial crisis. Can't measure that. What in the heck is going on? And when you think about the biggest risk that's hardest to measure, it's probably operational. What comes under operational risk is everything under the sun. If the lights don't turn on, that's your risk. But business resiliency, cybercrime, all these different risks that you can't measure easily get into this bucket, and you have to reserve capital for. And by the way, for those of you that don't know, banks, I can talk up here in initials and you don't even know what I'm talking about, but if you look at the mischief in banking, as I like to call it, you have the Securities and Exchange Commissions involved, you have the Federal Reserve, and you have the OCC. They're all looking at your balance sheets. In case you're wondering, how you tell the difference is a bank like our technical name is PNC, N.A. The N and the A are for National Association. That means we're a federally chartered bank. Comerica would be the best example here locally, that they're a state chartered bank, and they come under the view of the Federal Reserve, now the Office of the Comptroller of Currency. Doesn't make Comerica better or worse than PNC, but it's just, there's different agencies. But take the Securities and Exchange Commission for just a minute, and the Federal Reserve and the OCC. You'll see what I'm talking about this tension. The SEC thinks everything should be measured, and you don't want any kind of kitty of protection of reserves, because that's a way you can hide earnings. You can manipulate earnings if you have this bucket of money that kind of is just sitting over here. Call it for operational risk. They want everything measured, or they're going to write you up. The Federal Reserve and the OCC sleep better at night if you have a bucket of money. Somebody back there has a Hello Kitty backpack. I saw it earlier. If you're wondering why I know, because I have grandkids. But I'm not calling you, I don't have anybody your age. But that kitty is what makes them feel better at night. So you have this Rodney King thing, right? And why can't we all get along going on with the regulators? And so when we were setting the reserves, National City, or every other medium on it, you should see the tension between these two groups, and to get it right is not so simple. But so it's not everything is measurable, but in that operational risk category, is all the scary stuff. And I think probably, this might surprise you, but we do a lot of financial literacy workshops. And the number one with senior citizens is cyber. We get more requests to go into nursing homes, congregate care facilities, all around, what happens if my identity is stolen? And so I think that's probably not going to go away. I would tell you that we're tested every day by Iran, because we're a significant firm. Russia, some people think that Russia's behind the Chase problem. I don't know if that's true or not. Our thinking is that the Chinese mess with us but don't want to kill us because we own too much money. Maybe that's gallows humor, I don't know. But Iran messes with us. So we have a lot of people that don't look like me, that sit in dark rooms and figure out how to keep these bad guys away from us. But it's pretty serious business, and it's not going to go away. And I think some people think that, well, gee, it's just the big banks, but they're now pushing farther and farther down, because if you think about it, attacking Bank of America, Chase, is probably much harder than it is a small bank, say 10 billion in assets. So that's probably the biggest thing we have going, if you will. Does anybody have any questions on PNC or anything like that? I'd be remiss, I should probably back up. I'm from Detroit. My wife's from Detroit. And I worked at places that you've never heard of. First Federal Detroit, which is now Charter One, which is RBS, Comerica. And then I went to PNC Bank. But I also did a turn as an owner of a company. I was an owner of a commercial mortgage company. And the only reason I bring that up is, you get wanderlust when you're a banker. He's making all this money, and I'm as smart as he is, and he's a real estate developer or entrepreneur or whatever. So I did it, and the company no longer exists, but we had a warehouse line of credit that we put large mortgages in. We didn't do single-family stuff, but we represented companies that like Cigna, Nationwide. You definitely have seen their commercials, right? If you watch any football, you've seen Nationwide. Represented them. Well, we had this guy. He was dying of cancer, which is relevant to this. And him and his girlfriend at a title company made up fictitious mortgages. Put them in this warehouse, and that's a crime for lots of reasons, not the least of which is you defrauded a nationally chartered institution. Because at the time, National Bank of Detroit was our warehouse lender. So, yours truly got to go home and say, hey, honey, this thing I told you never have to worry about that we both signed? A little problem here, and I had little kids at the time. And the reason why I share that story is, I do think that, I can relate to borrowers. Because when they say, well, you're not signing, I can actually say, I've signed one of these and I've paid on it. I know what it's like to sign a guarantee. And the way that works, by the way, is if everybody in the front row is partners, you all sign, and then you indemnify each other behind the scenes for your respective ownership shares. But believe me, when the bank calls, they don't give a hoot about what you guys did behind the scenes. All they know is every one of you is joint several, including spouses or significant others. They come at everybody with the same philosophy. So, wrote the check, went back to banking at that point. But it does make you, I think it gives me more credibility with customers. Other thing people ask me about a lot is how in the heck did the guy that had trouble with the rent payment when he was in college, maybe a little trouble balancing his checkbook, ever end up in charge of commercial credit, or et cetera. And I would offer to people that the advice that my father gave me, I still take with me. He's been deceased for a while. But he said, find something nobody wants to do and do it really well. And for me, that meant I volunteered for every merger assignment there was. And we used to call them lost weekends. You would go away, you couldn't say where you were going, and you would go and look at banks' financial statements and their loans. And I'd say 75, 80% of the time you did and you did. But if you want to learn about the most important thing in mergers, it is culture. It's the hardest to measure. Everybody says they got the secret sauce. I'm here to tell you, that's the hardest piece. The reason why my father, in retrospect, gave me that advice is he had the distinct pleasure or displeasure of graduating from high school in January of 1942. So, it's like diploma here, draft guy there, and he volunteered to be a medic, which still astounds me because we're